Hi everyone, Mike and Jamie here today with another top 5, and today we're going to be talking about the top 5 opportunities created by market volatility. You heard me right, opportunities. So every time the market drops, headlines will be screaming panic and most investors freeze. But the investors who consistently build wealth, they see something different. They see opportunity. And today we're breaking down the top 5 opportunities that market volatility creates and how to actually use them.
I think we're going to share some concrete ideas that people could put into practice.
Yeah.
So I'm pretty excited about this one.
Let's turn this panic into a moment of opportunity. So number 5 is tax loss harvesting. What do we have to say about that, Michael?
Well, when investments go down and are at a loss, if you sell them, you can realize a capital loss. That can be really useful because those losses can offset future gains. Even in a year where things go down, things go up, you're buying and selling. When you're able to harvest that loss, that can be useful and carried forward into subsequent years if it's not fully utilized this year. So things go down, it's not good, but you can lower your tax burden.
Yeah, and we have a whole separate video on tax loss harvesting. If you're not really sure what that is, just go back into our archives in our YouTube channel and you'll see a whole video on tax loss harvesting and what it is. So check that one out if you don't know what that means. And let's pop into opportunity number 4. This is something that a lot of people don't think about, but opportunity number 4 is Roth conversions. And why does this matter during market volatility?
Well, maybe the best way to talk through this is to provide an example. Let's say you have $1 million account and it goes down by 10%. If you wanted to do a $100,000 Roth conversion this year, because that's where you wanted to stay tax-wise, you now have a $900,000 account. That $100,000 conversion in percentage terms is going to be more of that account going into the Roth than it would have been had markets not pulled back. So this is something for our clients that we actively seek out in times of turbulence as an opportunity to convert a larger percentage of their account into Roth IRAs.
Yep. So if you have a really big IRA, you've got a lot of pre-tax money just sitting around, this might be a great opportunity for you to ask your advisor, hey, are Roth conversions right for me? All right, opportunity number 3 are buying stocks on sale. We love this and we love saying this. What does this mean, Michael?
Buying low.
Buy low.
Sounds easy. It's not, because when things go lower, it's not a positive time for people's feelings and how they view markets. And so with some discipline, whether you're contributing to your 401k systematically, that's something you want to continue. If you have cash on hand, this is an opportunity that you wouldn't have had otherwise. I've heard people say that the investment store is the only one people run out of when things go on sale.
That's right. That's right. I love a good close sale. My shoes go on sale, I'm going to gobble them up, but investments go on sale.
Take some long-term thinking and kind of got to plug your nose and buy, but you can't do that when things are lower, then you're going to have a hard time as an investor.
That's right. That's right. All right. Opportunity number 2, rebalancing. What does this mean, Michael? What opportunity does this create?
When you build a portfolio, you have different types of assets, more than likely, different sectors within equity markets, different asset classes. When time progresses, inevitably, something's going to do well, something's going to be doing poorly. And so, at least for us, what we do is we systematically rebalance using what are called tolerance bands. So let's say that we just, simple example, started off with 50% stocks, 50% bonds. If we have a 10% tolerance band around our portfolio, if anything increases or decreases by more than 5%, we're going to sell what's up to buy what's lower. Systematically doing that over time gives you a chance to sell high and buy low without having to think about it. And, when you have volatility, is a great time to do it. One thing that I'll highlight here is a lot of people will consider rebalancing on a calendar basis. And while that will work over the long run, keep your portfolio from falling too far out of whack from what your target allocation is, you might miss opportunities within the calendar year. 2020 is a great example where we had a sharp decline because of COVID in March. Stocks went down north of 20%. They finished up the year positive 20%. If you waited calendar year, you missed the best buying opportunity that was available. So I'm a big fan of using tolerance bands. You can use this in your 401k. If you're investing with us, we're doing this already.
Yep. And this is a great segue into our number 1 opportunity created by market volatility is stay the course. Okay, stay the course. What does this mean?
When markets go down, when you have volatility to the downside, it's tempting to want to reduce risk. And internally, our emotions are driving us to do something that is suboptimal from an investment standpoint. And This is where you really want to be a contrarian, especially with regards to your emotion. Warren Buffett's famous for saying, be fearful when others are greedy and greedy when they're fearful. And in order to do that, you have to do the opposite of what your instincts are telling you from a volatility standpoint. Staying the course, sticking with your investment program. It's not easy when things are not going well, but that's often the best idea. Don't, do something to sit there and do nothing. Might not seem like it feels good, but it can lead to the best possible outcome.
Yeah, stick with your investment program. Hopefully you have a financial plan. You have a planner that you're working with. The advisor will likely say, please stick the course. Don't sell when it's low and buy high. Just stay the course, ride this out. Some of the best advice we can give. Okay, so I've got a couple quotes here just to finish off our top 5 opportunities during market volatility. Volatility, I love this quote. Volatility isn't just something to survive, it's something to use. So let's think more of volatility as an opportunity tool and not just a time to panic. The investors who build real wealth aren't the ones who avoid downturns. They're the ones who are prepared for them, understand them, and take advantage of them. And I don't know if I've heard anything truer than that.
No,
that is how you build wealth. Okay, and I'm just going to add, kind of as a little bow on top, why do most people miss these opportunities? Well, there are 4 reasons we have listed of why people can miss these top opportunities. Number 1 is emotion overrides logic. People are fearful. Fear and panic are the enemy of rational decision making, and we have seen that over and over in our career during market downturns. Volatility is designed to feel unbearable right when the best opportunities emerge. So don't let your emotion override your logic. If you're panicking, just call your financial advisor. Just have a quick discussion. You'll feel much better. Number 2, lack of a plan. Investors without a written financial plan have nothing to anchor to when markets get ugly. A plan is what separates reaction from strategy. So if you don't have a plan, reach out. We'd love to help you with that. Number 3, consuming too much negative media.
Oh boy.
What do you have to say about that, Michael? You have anything to add? I mean,
if it bleeds, it leads.
Yep.
Everything in the news is designed to be provocative and sensationalized.
Yep.
Not that there aren't things to be concerned about. There are, but if you watch the news, that will influence your emotions to the point where you might make a bad behavioral move.
100%.
With your investments.
Yep. Financial news is optimized for engagement, not accuracy. Headlines are written to provoke and not to help you invest well.
And not that I'm going to call anyone out in particular here, but I've noticed, especially this year, a lot of semi-half-truths.
Yep, the media can
But I'm saying in the news where I'm reading something or listening to something, and that's true, but you're missing, anyways.
Yep. So just be careful of the media because it's not always projected to give accurate information anymore. And then the last thing of why most people miss these opportunities is because they're waiting for certainty, which, spoiler alert, it never comes. So markets don't ring a bell at the bottom. By the time everyone feels comfortable, the biggest gains are already gone. By the time things feel safe again, the opportunity is usually gone. So just be ready for when market volatility hits. We have one client who is so great when the market goes down. He always shoots us a text, he shoots us an email, and he says, okay, what are we buying? And we love that client.
Absolutely.
He understands the markets. He understands how to build wealth.
And I want to be sympathetic here. I know I probably should have said this at the beginning, but when we're dealing with people's life savings and you have a volatile market to the downside is difficult to stomach, and we understand that. That's why I think having this discipline, understanding your investments, what they're designed to do, having a plan, so critical.
Yeah.
Because those are the tools as financial advisors we use to help people to not only make it through these times, but come out better on the other end.
And that's a great point because market volatility is not fun. It's not fun for us as advisors, but it does create opportunities that we want you to be aware of. So thank you for joining us for our top 5 for the week. And until next time, take care.